Good afternoon, ladies and gentlemen. It's a great pleasure being here finally at the VRIC. It's my very first time. We're going to talk about the Showdown, and I appreciate the fact that Nick is actually a proper Austrian economist. So you probably heard it already. I'm Austrian. Don't mix it up with Australia. It's this tiny country in Europe. Yeah, and I really look forward to the next 20 minutes. My name is Ronald Stoeferle. I'm managing partner at Incrementum AG, which is a boutique asset manager based in Liechtenstein. Many people know me for this little report that I'm publishing for 17 years now. It's the In Gold We Trust report. Save the date, ladies and gentlemen. 17th of May is going to be the next publication date. And we reached 2 million people with this report. So there's not only the big report, but also a compact version. We've got 12 monthly chart books. We do special reports. Everything is available for free. You can download everything on our webpage because from my point of view, it's important to educate people and to inform people about proper monetary insurance. And it wouldn't be possible without the support of our premium partner to give out everything totally for free. But let's jump into the topic of showdowns. If you search the dictionary for the meaning of showdown, you will get the following definition. A conclusive settlement of an issue in which all resources and all sources of power are used, or the laying down of one's cards, face upward in a game of poker. Now, in history, we have witnessed many showdowns. Darius of Persia versus Alexander the Great. We've seen it in business. Pepsi versus Coca-Cola. Microsoft versus Apple. And of course, we're also seeing it in politics. We all look forward to the great political showdown of the young, hungry political upstarts Joe Biden and Donald Trump this year. And ladies and gentlemen, there are real showdowns, but there are also fake showdowns. I'm not sure if you're familiar with the world of professional wrestling, but in wrestling there's usually two different characters. There's the heel and the face. The face is usually the good guy, the most likable character. They're usually brave, honest, and good looking. I don't know, the women here, would you say that he's good? It's a little bit 90s, but that's Brett Hitman Hart. And then there's the so-called heel. The heel is the bad guy. He's always evil, dishonest, a cheat who complains and fakes injuries. But sometimes, however, the heel becomes more popular. And then he actually experiences a so-called heel turn. The villain becomes the good guy. The villain becomes the hero. The best example of that is The Rock. You all probably know him. He played the role of the bad guy so well that everybody loved him. Everybody remembers his trademark, the people's elbow or the rock bottom, or his slogan, "Can you smell what The Rock is cooking?" Now, why am I talking about heel turns and professional wrestling? We'll come back to that in a second. But in the world of financial markets, there's actually three different showdowns going on. There's the showdown in monetary policy, the showdown East versus the West, and the showdown in the gold price. And this is going to be the core topic of this presentation. Let's talk about the showdown in monetary policy. As you can see, thanks to artificial intelligence who built this picture, the Federal Reserve is playing a game of chicken against inflation. Who will budge first? It seems that we have now hit the point where the Fed must choose between fighting inflation and financial stability. If the Fed chooses the tight road, they will probably risk that markets, especially the bond market, continue to revolt. And turmoil in equity markets will continue at some point. On the other hand, if the Federal Reserve chooses financial stability over fighting inflation, the Fed will risk losing the credibility that they have painstakingly rebuilt over the last couple of months. And when I'm talking about credibility, it's important to go back in history. As you know, after President Nixon in 1971 cut the tie between the dollar and gold, markets endured a decade of chaos, a decade of stagflation and volatility. But that was launched by the Federal Reserve under Paul Volcker, who effectively replaced gold with the concept of Fed credibility by showing that he was prepared to force the US into recession, to control inflation. He was able to keep the dollar as the center of the global financial system. And this led to a steady downward trend in inflation rates. As you can see here, we basically had 4 decades of falling inflation. Now, after 2 decades of zero interest rates coinciding with exponential increases in money supply, the time has now come to pay the piper. Ladies and gentlemen, from my point of view, the era of the great moderation is over. Now, why is that important? It's so important because a generation of asset managers, of wealth allocators, of investors in general, they all grew up during 4 decades of falling inflation rates. Inflation was the least concern for structuring a portfolio. But this has changed now. And from my point of view, we're moving into recession. I don't buy into the soft landing or the no landing narrative. I tweeted out today actually a survey that was about the Google searches for the term recession. They have completely collapsed. Nobody is searching for the term recession at the moment at Google, which might, from a contrarian point of view, be a good sign. Have a look at this chart. It shows the so-called leading economic indicator, one of the most reliable economic indicators. And what you can see is that this index now has declined 20 months in a row, which is the 3rd longest decline in the last 70 years. Every time this has been larger than 6 months, the US went into recession. Have a look at this chart. It shows US bank credit. And usually, as you know, credit is the lifeblood of modern economies. If we see deteriorating credit conditions, this is both a signpost, but also a cause of recessions. Now, usually, as you can see, even weakening momentum of credit growth is a sign that we are moving into a recessionary environment. But what we're seeing now is even negative growth. So we are seeing contracting bank credit, which is a big warning sign. Actually, the last time we saw it was in 2008, 2009. So, ladies and gentlemen, I'm clearly not in the soft landing camp. The only reason why the US is not in a recession yet is because they're running a budget deficit of 8%. We've never seen it in the last 100 years outside of recessions or major wars. And of course, this fiscal stimulus works. But at some point, somebody has to pay the bills. And as we're heading into election year, I'm pretty certain that this fiscal stimulus will be slowly fading out. And of course, Democrats will try everything to avoid the R word, while the Republicans will try everything to paint a very negative picture of the US economy. Now, why is it important? We crunched the numbers in our last In Gold We Trust report and said, well, actually, a recession is not the end of the world. It's just a reallocation of resources. And as you can see on this chart, gold actually is a pretty reliable recession hedge, while silver, the S&P and commodities only start really performing at later stages of a recession. Interestingly, we couldn't believe it actually, mining stocks perform pretty well except for phase 3. So this is the later part of recessions. So if you think a recession is coming, ladies and gentlemen, I think that gold is a pretty good idea. Now let's talk about the second showdown, the East versus the West. We know that this has been, over centuries, a reoccurring topic. Alexander the Great versus Darius of Persia, the Crusades, the Ottoman Empire versus the Austro-Hungarian Empire, and of course, the Cold War. Now, we're seeing that in geoeconomics, a showdown is approaching, a showdown between the saturated establishment and the hungry upstarts in emerging markets. If you have a look at this chart, it shows the share of global GDP in purchasing power parity. And actually in 2020, the BRICS have already taken over from G7 nations. Now with the last BRICS summit in South Africa, they decided that 6 new members will join. But Mr. Milei in Argentina, he backed down and said, well, I'm not going to join the BRICS. I will be in the dollarization camp. Pretty interesting development. But still, it is Saudi Arabia, Egypt, Ethiopia, Iran, and the United Arab Emirates joining the BRICS now, which is pretty important for the gold world. You probably saw this tweet coming out from the Russian embassy in Kenya. This brought quite a lot of excitement in the gold world, and it said the BRICS countries are planning to introduce a new trading currency which will be backed by gold. Now, I would be a little bit cautious and take every information that comes out from the Russian embassy in Kenya with a grain of salt. However, what is crystal clear is that gold plays a major role for emerging markets. Have a look at this chart. In 2022, we saw an all-time high in central bank buying activity. For 2023, we haven't seen the final numbers yet, but it will clearly be above 1,000 tons. So significant. Now, what changed actually? What's the main reason for that? What's the trigger? It was the decision by the West in February 2022 to freeze the dollar and euro reserves of the Russian central bank. Now, we have seen over history sanctions against pariah states such as Venezuela, Iran, Afghanistan, but never before have we seen sanctions against a member, a state with veto power in the UN Security Council, a former member of the leading economic nations, a nuclear power, and one of the most important exporters of raw materials. So this decision by the West against Russia, from my point of view, was really a trigger for many emerging market countries to rethink their allocation. Because it showed that reserves can quickly transform from a highly liquid asset to useless pieces of printed paper. And from my point of view, more and more countries will reconsider the allocation of their gold reserves. And the numbers that we're talking about are enormous. At the moment, the global foreign exchange reserves of central banks amount to 12 trillion US dollars. So ladies and gentlemen, gold has re-emerged as a neutral monetary reserve asset. But it's not only central bank demand that is dominated by the East. Have a look at this chart. It shows quarterly consumer demand for gold, BRICS versus G7. China and India alone, they went from 28% of global gold consumer demand in 2000 to now 50%. India imported 17,000 tons of gold in the last 2 decades. At the moment, Indians hold 29,000 tons of gold, which is more than the combined holdings of the 27 largest central bank gold holders in the world. China has imported 18,000 tons of gold over the last 20 years. And even though the PBOC reserves are pretty small, a Chinese official recently said, when he was asked how much gold China actually has, he said, China owns gold through its people. Very important quote from my point of view. So ladies and gentlemen, if you think about gold, always think about these flows that are going from the Western world to emerging markets. So the flow of physical gold has shifted from west to east in the last couple of years. And the price of gold is increasingly being made in Dubai, in Shanghai, and in Mumbai, and less so in Zurich and London and New York. Now, are we seeing the renaissance of gold as a central bank asset? Yeah, perhaps. Central bank demand might become one of the main drivers of this next bull market. What you see here is global central bank gold holdings as a percent of foreign reserves. And you can see that in the 70s up to the 80s, central banks held 70 to 80% of their reserves in gold. Now, are we going back to those levels? Probably not, but we can easily double to 35 to 40%. And this is a heel turn, ladies and gentlemen. The bad guy becomes the good guy. We're seeing that gold is coming back into the system as a neutral monetary reserve asset. But now let's talk about the showdown in the price of gold. First of all, and look at this chart, a table showing the performance of gold in various currencies. While gold was up 13% last year in US dollar terms, gold was up 21% in Japanese yen terms. Gold was up in euro terms, 9.7%. And the compound annual growth rate since the year 2000 in dollar terms, 8.5%. 8.5% performance every year. I would say not too shabby. However, if we have a look at Western financial investors, you could see that Western financial investors couldn't care less about gold at the moment. We've seen outflows in gold ETFs last year, even though gold was making new all-time highs. Outflows, roughly 250 tons. But there we're also seeing a divergence between the East and the West. While the Western investors have sold dramatic amounts of gold, Eastern ETFs even saw inflows. And from my point of view, ladies and gentlemen, investor demand will at some point kick in and new players will enter the field. So investors' demand could be the marginal demand that we will really need to see coming in for more momentum in the price of gold. The next one is one of my very favorite charts. I said a little bit too early, but then I think it became clear in fall last year that the pivot of the Federal Reserve is coming. Now, we crunched the numbers and calculated what happens to gold when the Fed stops hiking interest rates. It's a pretty good setup. Plus 43%, plus 76%, plus 54%, and now 5% yet. So, ladies and gentlemen, the best is yet to come. If you would have told me 2 years ago that interest rates will rise to 5%, that inflation is coming down, that real rates would be surging, and that gold would be trading at or close to all-time highs, I would have said no. Gold should be trading at around 15 to 1600. But now, with falling interest rates, sooner or later, I think that markets are a little bit too optimistic at the moment. I think the best is yet to come. Now, when it comes to the miners, well, it's a little bit different. In the first cycle, up 191%. And then, of course, the second cycle, minus 68%. But you can also see from the point when the Fed started hitting the pause button, then actually quite a dynamic rally. Then, obviously, 2008, 2009, great financial crisis. And then another big move. And then, here, 2019, up 93%. So for the gold mining stocks, I think it should also be a good setup, but we gotta be a little bit more cautious with the timing. Now, as I've said before, gold is back to its all-time highs, basically, but miners would have to rise 160% to go up to new all-time highs. And actually, I think miners are always ridiculed that they didn't show any outperformance to the price of gold. Well, actually, they have. In the last big cycle, you can see that it massively outperformed the gold price itself. Can it happen at some point again? I think so. But when it comes to the risk appetite at the moment, I would say, well, don't be too optimistic yet. The silver to gold ratio is falling. So silver is underperforming gold. In a strong bull market for gold, you want to see silver outperforming. GDX versus gold. It's kind of going sideways. You want to see mining stocks really outperforming gold. GDXJ versus GDX, it's kind of rising. But this is telling me, well, actually, we're probably not there yet. Now is the time to really do your homework, to prepare. But I think at some point in 2024, probably when they do the first rate cut, I think that's going to be the best setup for gold that we can imagine. Conclusions, ladies and gentlemen. Decades of disinflation have ended. We should expect more inflation volatility. So the great moderation is over. Inflation for every investor will become one of the more important factors. We've seen an inflation shock, a rate shock, now the pivot, and the next one will be the recession. As you have seen before, gold works pretty well in the course of recessions. Why? Because there's monetary and fiscal stimulus during recessions. We've seen a heel turn in reserve assets. Gold is coming back. We're seeing a renaissance of gold as a monetary asset. And for the next 12 months, I would see $2,300 as the first target, but based on our technical indicators, my next target would be $2,700. Ladies and gentlemen, thank you very much for your attention. I hope you enjoyed it. Thank you very much.